Welcome to the deep dive. Today we're tackling something really core for financial reporting exams, group accounts.
Yeah, definitely a big one. It often feels like the Mount Everest for students.
It does, but we want to show it's climbable. It's really built on, well, a few key ideas and a lot of discipline in how you structure your answer.
That structure is absolutely vital, and the logic behind it all.
So our mission today is to give you that expert exam-focused voice overview. We'll break down the consolidated statement of financial position,
This DSFP,
a
yes.
consolidated statement of profit or loss, the CSPL,
Mm-hmm.
and how to handle associates, really focusing on those workings the examiner expects.
And it's crucial to get beyond just the numbers, the adding up, you need the why. The whole reason we do group accounting, especially under IFRS, it pivots on the IASB's conceptual framework.
The framework, specifically that principle of...
Substance over legal form. That's the
Yeah.
bedrock.
Right, because legally you might have P Limited and S Limited, two totally separate companies, right? Filing their own taxes, separate legal papers.
Correct. Legally distinct. But, and this is the key thing, if PLTD controls SLTD, economically they're acting as one, as a single unit.
So consolidation is about reflecting that economic reality.
Precisely. You're basically tearing down those legal walls for reporting purposes. You present the combined entity, let's call it P Group Ltd, as one unified set of accounts.
Because that's the only way investors, lenders, anyone reading the accounts gets a true and fair view.
Exactly. A true picture of the group's actual economic position, its assets, its debts, and importantly, its performance. IFRS 10 spells it out. A parent controls one or more subsidiaries.
And a subsidiary is controlled by the parent. It sounds simple, but that word control, that's where the complexity starts, isn't it?
It really is. The whole process hinges on defining control.
The easy definition, the one everyone learns first, is owning more than 50% of the voting shares. Simple majority.
That's the usual starting point, yes. More than 50% normally equals control. But, and this is crucial for the exam, the sources make it clear examiners will test the gray areas.
Situations where the percentage doesn't paint the full picture.
Absolutely.
Yeah.
Because control fundamentally isn't just about ownership percentage. It's about power.
Power. Define that in this context.
It's the power to govern the financial and operating policies of the entity,
Okay.
so that the investor, the parent, gets benefits from its activities. That's the IFRS definition, essentially.
So 50% usually gives you that power, but not always. And you can have the power without 50%.
Correct. Think about it. What if you own, say, 40%?
Okay, 40%.
But the other 60% of the voting rights are scattered amongst thousands of tiny shareholders who never turn up to meetings or vote.
So practically your 40% block can push through any decision.
Realistically, yes. You might have de facto control. Or maybe you have a contract with another shareholder that gives you the majority vote together.
Contractual arrangements, right?
Or even potential voting rights. Maybe you hold options or convertibles that, if exercised right now, would give you control. The standard looks at the present ability to direct.
So if I have, say, 40% equity, but clearly exercise control through one of these other ways, I must consolidate 100%, even though I only technically own 40%.
Yes, that's the substance over form principle biting hard. If control exists, you consolidate 100% of the assets and liabilities. The 40% ownership only affects how we slice up the equity and the profit later on.
That feels counterintuitive initially. You control everything, so you show everything, but you only own part of the resulting equity.
It is counterintuitive if you're stuck on legal ownership, but it reflects the economic power. The parent directs all the resources.
Okay, so the big takeaway for the exam. Don't just look at the share percentage. Read the story, the narrative details, look for evidence of power.
That's the golden rule. Control means 100% consolidation. Ownership percentage dictates NCI and profit splits.
Got it. So to help everyone navigate this, we're going to walk through the structure examiners expect. First, the Consolidated Statement of Financial Position, the CSFP.
Yep, the balance sheet. That's where most of the detailed workings live.
Then the Consolidated Statement of Profit or Loss, the CSPL,
Performance for the year.
focusing on things like mid-year acquisitions and eliminations. And finally, we'll touch on associates under IAS 28, what happens when you have influence, but not full control.
Sounds like a plan. Let's start with the CSFP.
Right, the group balance sheet, the CSFP. This is where, as you said, the heavy lifting often happens. How do we even begin constructing that single group picture from, say, PLTDs and SLTDs separate accounts?
The absolute starting point, the non-negotiable principle is this. If control exists, you combine 100% of the parent's identifiable assets and liabilities with 100% of the subsidiary's identifiable assets and liabilities, line by line.
100%. Even if the parent only owns, let's say, 75% of the subsidiary, like Peter Group owning 75% of Stephen Co. in one of the examples?
Yes. Even then, you add 100% of Stephen Co.'s cash, 100% of their buildings, 100% of their inventory, 100% of their loans, everything.
Okay, I know this trips people up. Why add 100% of the assets and liabilities if we only own 75%? Where does that other 25% sort of go? Does it just vanish?
It doesn't vanish, no. It gets accounted for, but separately. We consolidate 100% of the assets and liabilities because the parent, having control, directs the use of all those resources. They decide what happens with 100% of the factory, how 100% of the debt is managed.
Ah, so it reflects the control over the resources, not the ownership of the value.
Precisely. You control the whole operation, so you show the whole operation's assets and liabilities. But you're right, the parent can't claim 100% of the equity or the net assets. That's where two critical adjustments come in immediately.
Okay, what are they?
First, you have to eliminate the parent's investment in subsidiary asset from its own balance sheet.
Right. P paid something for S. That's sitting as an asset for P. Why eliminate it?
Because if you don't, you'd be double counting. You'd have the investment asset and you'd be adding in all of S's individual assets and liabilities. So the investment cost is canceled out against the equity of the subsidiary that existed when the parent bought it, the pre-acquisition equity.
Okay, so investment asset gone, canceled against S's pre-acquisition equity. That clears the decks a bit. What's the second critical step?
That's where the 25% comes back in. We need to recognize the share of the subsidiary's net assets that belongs to the other owners, the ones who aren't the parent. This is the non-controlling interest, or NCI.
NCI. So
Okay.
if P owns 75%, NCI is the other 25%. And where does this NCI figure actually appear on the consolidated balance sheet?
It's shown within the equity section of the CSFP,
Okay.
right alongside the parent's equity, like share capital and retained earnings. It represents the NCI's claim on the group's net assets. They are, in effect, equity holders in the group, just not the controlling ones.
Okay, so it's part of group equity. And is that NCI figure calculated once at acquisition and just stays there?
Oh, no, definitely not. It changes over time. The NCI calculation, which is usually working for, or W4, needs to be done really carefully.
How does it work? What makes it change?
You start with the NCI's value at the date of acquisition. Then, crucially, you add the NCI's percentage share of all the subsidiaries' post-acquisition profits and other equity movements.
So if S makes a profit after P buys it, 25% of that profit gets added to the NCI figure on the balance sheet.
Exactly. And 25% of any post-acquisition revaluations or other reserve movements in the subsidiary, too. The NCI shares in the subsidiary's fortunes, good or bad, after the acquisition date.
You mentioned calculating NCI at acquisition. The sources say there are two different ways to do this, and the choice has a big impact later, especially on goodwill.
Yes, this is a really important exam point. IFRS 3 gives you a choice on how to measure NCI at the acquisition date.
What's method one?
Method 1 is the proportionate share of net assets method. It's often seen as simpler. You just take the NCI percentage, say 25%, and multiply it by the fair value of the subsidiary's identifiable net assets at acquisition.
Okay, 25% of S's net assets at acquisition date. Why is this sometimes called the partial goodwill method?
Because this calculation only reflects the NCI share of the identifiable net assets. It deliberately ignores any goodwill that might be associated with that 25% stake. So the goodwill we calculate later will only be the parent's share of the goodwill, hence partial goodwill.
Right. And the alternative, method two.
Method 2 is the fair value FV method. Here, you measure the NCI at its fair value on the acquisition date. Usually, this is based on the market price of the subsidiary shares at that date, if they're traded.
So you look at the share price for the 25% we don't own and use that. Why does this lead to full goodwill?
Because the market price of those shares usually reflects everything, the identifiable assets and the implied value of unidentifiable things like reputation, brand, synergies, essentially the goodwill attributable to the NCI stake as well as the parents.
Ah, so the fair value method captures the market's valuation of the entire subsidiary's goodwill, not just the part the parent paid for.
Precisely. By using the fair value of the NCI, the resulting goodwill calculation captures the goodwill of the whole subsidiary. That's why it's called full goodwill.
This choice sounds like it has major knock-on effects.
Huge, especially for calculating goodwill itself and how you treat any subsequent impairment of that goodwill.
Okay, let's bridge directly to that. Goodwill, working 3W3. It's essentially the premium paid over the fair value of the net assets acquired, right? Reflecting things like brand, customer loyalty.
Exactly. It's the difference between what the group effectively paid for the subsidiary, including the value attributed to the NCI, and the fair value of what they actually got in terms of identifiable net assets. It's a residual amount.
So walk us through the step-by-step calculation for W3, goodwill at acquisition. How do those NCI methods fit in?
Okay, meticulously, it's 1. Start with the fair value of the consideration the parent transferred. This could be cash, shares issued, deferred amounts, whatever the parent gave up.
Step 1, parent's cost.
Yeah.
Got it.
2. ADD, the non-controlling interest at acquisition, from W4. And here's the key. You use the value calculated using either the proportionate share method or the fair value method, depending on the group's accounting policy choice.
Okay, so the NCI value plugs straight in here. That's where the choice bites.
Exactly. 3. Subtract the fair value of the subsidiary's net assets at the date of acquisition. This figure comes from another crucial working, W2, the net assets schedule.
Right, W2 calculates the sub's net assets at acquisition, adjusted for fair values.
Correct. So consideration plus NCI FV of net assets, goodwill at acquisition.
And the examples show this makes a real difference. Using proportionate share NCI gives lower goodwill than using fair value NCI.
Significantly lower, often, because the fair value NCI brings in that extra layer of implied NCI goodwill.
Now, goodwill isn't amortized anymore, but it has to be tested for impairment every year. How does the NCI measurement choice affect impairment?
This is a classic exam question. It depends entirely on which method you used for NCI at acquisition.
Okay, scenario 1. We use the fair value method for NCI, resulting in full goodwill. What happens if that goodwill gets impaired?
If you have full goodwill, any impairment loss must be allocated between the parent and the NCI. You split it pro rata based on their ownership percentages at the year end.
So, if goodwill is impaired by $10,000 and P owns 75%, NCI is 25%.
Then $7,500 of the impairment loss hits group retained earnings, W5, and $2,500 hits the NCI, W4. It reduces both equity components.
Why? Because the original goodwill calculation included value attributable to both.
Exactly. The full goodwill belongs conceptually to both the parent and the NCI, so they both share the pain if it gets impaired.
Okay, logical. Now, scenario 2. We use the proportionate share method for NCI, partial goodwill. How is impairment treated then?
In this case, the impairment loss is allocated 100% to the parent. It all goes against group retained earnings, W5. The NCI figure, W4, is untouched by the goodwill impairment.
Why the difference?
Because the partial goodwill calculated only ever represented the parent's share of the goodwill. The NCI share was never recognized in the first place. Therefore, only the parent's equity should suffer when that specific goodwill is impaired.
That's a critical distinction. You absolutely have to know which NCI method was used to allocate impairment correctly. Get that wrong, and W4 and W5 are incorrect.
Absolutely. It's a high reward area if you get it right, and high penalty if you get it wrong.
Okay, moving on. We've got the basics. 100% line by line, eliminate investment, calculate NCI and goodwill. But the real world and the exam hall is messy. There are always adjustments. This is where you said it separates the masters from the rest.
It really is. These adjustments ensure the consolidated accounts truly reflect that single economic entity idea. Ironing out internal transactions and aligning values, and doing them requires discipline. Those standard workings are essential.
Let's quickly recap those key workings examiners expect to see for the CSFP. You mentioned W1 to W5.
Yes. Clear, well-structured workings are non-negotiable for good marks. The examiner needs to follow your logic, typically. W1. Group structure just maps out who owns what percentage of whom and the acquisition dates. Simple, but sets the scene. W2. Net assets of subsidiary. This is often the engine room. You track the sub's equity from acquisition date to reporting date, splitting out pre- and post-acquisition movements and incorporating fair value adjustments. Huge marks here. W3. Goodwill, the calculation we just discussed. W4. Non-controlling interest, tracking the NCI share from acquisition to reporting date. W5. Group retained earnings starts with parents' retained earnings as parent share of subs post-acquisition profits from W2 and takes various adjustments like PUP and goodwill impairment.
Okay, W1 to W5, got it. Let's tackle the adjustments themselves. First up, eliminating internal debts, intragroup balances.
Right. If P owes S money or S owes P money, that receivable and payable have to disappear in the consolidated accounts because the group cannot owe money to itself. It's an internal transaction that's meaningless from the outside perspective. So you eliminate 100% of the mutual debt.
How? What's the journal?
Simple cancellation. You debit the payable account, wherever it sits, P or S, and credit the receivable account, P or S, for the amount of the intergroup balance. They net off to zero.
Okay, sounds straightforward. But what about the classic exam trick, cash in transit, where P says S owes $1,500, but S's books only show a payable of $1,000 because they've already sent a check for $500. The balances don't match.
Ah, yes, the cash in transit or goods in transit scenario.
Yeah.
This tests whether you understand the sequence. You can't just eliminate the $1,000 that matches. You have to fix the mismatch first.
Face it, how?
You have to adjust the receiver's books to reflect the item in transit before you do the elimination. In your example, P hasn't received the $500 cash yet.
So P needs to record it.
Yes. P needs to recognize that the cash is on its way. The adjustment in P's records before consolidation elimination would be debit cash in transit, $500. Credit receivables from S, $500.
Okay, so P's receivable from S drops from $1,500 to $1,000. Now it matches S's payable of $1,000.
Exactly. Step 1, adjust for the item in transit. Step 2, now eliminate the matching balances. Debit S's payable $1,000, credit P's adjusted receivable $1,000. Done.
If you forget step 1, the adjustment for cash in transit.
Your final consolidated cash figure will be wrong, your receivables will be wrong, your payables will be wrong. You have to reconcile before you eliminate.
Got it. Crucial sequence. Okay, next big adjustment. Unrealized profit, or PUP. This feels like pure substance over form again.
Absolutely. This is about internal sales within the group. If, say, P sells inventory to S for $100, and that inventory originally cost P $80, P has booked a $20 profit.
Okay, standard sale for P.
But if, at the year end, S still holds that inventory, has the group actually made a $20 profit yet?
No, because it hasn't been sold to an external customer. It's still sitting within the group boundary.
Precisely. That $20 profit is unrealized from the group's perspective. We can't recognize it until S sells the inventory outside the group, so we have to eliminate it.
How do we eliminate the PUP?
Two things need adjusting. First, the inventory held by S is overstated by $20 from the group's perspective. It should be to the group cost of $80. So we need to credit inventory on the CSFP by $20.
Okay, reduce the inventory value. What's the debit?
The debit goes against the retained earnings of the company that made the unrealized profit, the seller.
The seller. Okay, this sounds like another crucial distinction for the exam. Who made the sale matters.
Hugely. This determines where the adjustment hits your workings. If the subsidiary S sold the goods to the parent P, the $20 PUP reduces S's profits. So debit goes into W2, net assets of S, specifically reducing the post-acquisition profit column. If the parent P sold the goods to the subsidiary S, the $20 PUP reduces P's profits. So the debit goes directly into W5, group retained earnings.
Wow. Okay, so if S is the seller, the PUP adjustment reduces the post-acquisition profit in W2, which then gets split between the parent in W5 and the NCI in W4.
Correct. If S sells, the NCI shares in the reduction of profit.
But if P is the seller, the adjustment only hits W5, the parent's retained earnings. The NCI is unaffected.
Exactly, because the NCI has no stake in the parent's individual profits.
Getting that direction wrong, who the seller is, could mess up W2, W4, and W5.
Completely. It's a cascade effect. You have to identify the seller correctly.
Does the same principle apply if the intergroup sale was a non-current asset, like P selling a machine to S at a profit?
Yes, the core principle is the same. Eliminate the unrealized profit. If P sold a machine, carrying amount $50K to S for $70K, there's a $20K unrealized profit.
So adjust the asset value down and hit the seller's retained earnings.
Correct. You'd credit property, plant, and equipment, PPE, on the CSFP by $20K to bring it back to the group's carrying amount, $50K. Right. And you debit the seller's retained earnings, W5 if P sold, W2 if S sold, by $20.
Is there an extra wrinkle with non-current assets compared to inventory?
Yes, depreciation. S, the buyer, will now be depreciating the asset based on the inflated intergroup price, $70K. But the group should only be depreciating it based on the group's cost, $50.
Yeah. So S is charging too much depreciation in its own accounts from the group's perspective.
Exactly. So each year, you need to make another adjustment to reverse the excess depreciation charged by S.
How does that work?
You debit PPE, increasing its carrying amount slightly each year, and credit the seller's retained earnings, W2 or W5, for the amount of the excess depreciation. This correction continues until the asset is disposed of outside the group or fully depreciated. It often comes up in the CSPL adjustments, too.
Okay, PUP on inventory and non-current assets, crucial adjustments. What about fair value adjustments required by IFRS 3 at acquisition?
Right. IFRS 3 isn't just about goodwill. It also says that when a parent acquires a subsidiary, it must measure all of the subsidiary's identifiable assets and liabilities at their fair value on the acquisition date for consolidation purposes.
Even if the subsidiary's own accounts still carry them at historical cost.
Yes. The group accounts must reflect the fair value at the point control was obtained. So if SLTD has land on its books at $1 million cost, but its fair market value at acquisition was $1.5 million.
We have to recognize that extra $500,000 value in the group accounts.
Correct. That $500,000 upward fair value adjustment, FVA, needs to be incorporated into the subsidiary's net assets calculation, W2 at acquisition.
How does that affect goodwill?
It increases the net assets at acquisition figure, the denominator in the goodwill calculation. Higher net assets mean lower goodwill, all else being equal.
Okay, so fair value uplift increases net assets in W2. But you mentioned earlier this often creates a tax issue, deferred tax.
Yes, this is a higher level point, but absolutely essential for good marks. When you revalue an asset upwards for consolidation, its carrying amount in the group accounts, $5 meter land, is now higher than its tax base, likely still $1 a cost for tax purposes.
That difference is a temporary difference.
It's a taxable temporary difference, and IAS 12 on income taxes requires you to recognize a deferred tax liability DTL on such differences.
A DTL. So the fair value uplift creates an asset increase, but also a liability increase.
Exactly. You need to calculate the DTL. Right. So the temporary difference, $500, multiplied by the applicable tax rate, say 20%. That gives you a $100 gate DTL.
And where does this DTL go in our workings?
It's treated as a liability of the subsidiary at acquisition. So it reduces the net assets figure in W2 at acquisition.
Wait, so the $500 K fair value uplift increases net assets, but the resulting $100 K DTL decreases them. The net impact on W2 at acquisition is only $400 K increase.
Precisely. You bring the asset in at fair value, but you also recognize the future tax consequence associated with that uplift. It dampens the impact on goodwill.
And does this DTL just sit there?
No, it unwinds over time, especially if the related asset is depreciable. If the FVA related to a building with a 10-year life, you'd be charging extra depreciation each year in W2 based on the uplift.
Right, we mentioned that, the $50 extra depreciation per year on a $500 K uplift over 10 years.
As you charge that extra depreciation, the temporary difference reduces. So you also need to gradually release the DTL. You'd release $10 K the DTL each year, $100 K 10 years.
How do you release it? What's the journey?
You debit the DTL liability, reducing it, and credit the income tax expense, effectively reducing the tax charge, in the subsidiary's post-acquisition column in W2, or in the CSPL. It's complex, linking IFRS 3, IAS 12, and IAS 16, but vital.
Definitely sounds like a multi-layered adjustment. Okay, one last area for CSFP adjustments before we move on. Complex consideration, like when the parent doesn't pay cash up front but promises to pay later. Deferred consideration.
Yes, this affects the initial goodwill calculation, W3. If the parent promises to pay, say, $100,000 in 3 years' time as part of the purchase price.
You can't just add $100,000 to the consideration figure in W3 today, can you? Time value of money.
Exactly. You have to record the deferred consideration at its present value, PV, on the acquisition date.
Yep.
You need to discount that future $100,000 back to today using an appropriate discount rate, like the parent's cost of borrowing.
So if the PV is, say, $75,131 using a 10% rate, that's the figure that goes into W3 as part of the consideration paid.
Correct. And you also recognize a corresponding liability on the CSFP for $75,131, usually called deferred consideration.
Is that it, or does something happen in later years?
Something definitely happens. That discount needs to unwind over the 3 years until the liability reaches the full $100,000 that needs to be paid.
Unwinding the discount, how does that work?
Each year, you calculate the interest expense on the opening liability balance. Using 10%, in year 1, the interest is 10% of $75,131, which is $7,531.
And the journal entry?
You debit finance cost, which goes to the CSPL or W5, with $7,513, and you credit the deferred consideration liability on the CSFP with $7,513. This increases the liability's carrying amount.
So the liability grows each year, and you recognize a finance cost.
Yes, until the liability reaches $100,000 just before payment is due. Forgetting to unwind the discount is a common error. It understates finance costs in the CSPL and understates the liability on the CSFP. Okay, measuring the group's annual income, The principle is still about that single economic entity, right? Absolutely. Reflecting the group's combined performance as if it were one company.
So the starting point, similar to the CSFP, is line-by-line addition. 100% of parents' revenue plus 100% of subsidiaries' revenue, and so on for costs.
Yes, that's the foundation. 100% plus 100% S for revenue, cost of sales, operating expenses, all the way down. But just like the CSFP, there are immediate, crucial eliminations needed.
Ah, the intergroup stuff again. What needs to go?
All intragroup trading transactions must be eliminated completely.
So if P sold $20 million of goods to S during the year, that $20 million needs to vanish from the consolidated revenue and the consolidated cost of sales.
Precisely. Because from a group perspective, no external sale occurred. That $20 is internal shuffling. You typically handle this in an adjustments column on your CSPL working schedule. Debit group revenue, $20. Credit group cost of sales, $20.
So it nets out overall profit but cleans up the gross profit figure.
Exactly. It prevents inflating the top-line revenue and cost figures. Same goes for any intragroup interest paid and received or management charges between P and S. They must be fully eliminated. Debit the expense line, credit the income line in the adjustments column.
Okay, elimination first. Now, what's the big complication that often appears in CSPL questions?
Mid-year acquisitions. This is a really common exam scenario.
Right. If the parent buys the subsidiary partway through the financial year, you can't just add 100% of the sub's full year results, can you?
No, absolutely not. You only consolidate the subsidiary's results, its revenue, its costs, its profits from the date of acquisition onwards.
So if the year ends Dex 31st and P buys S on July 1st.
You only include 6 months of S's performance in the group accounts for that year. The first 6 months, Jan 1st to June 30th, are pre-acquisition.
How do we practically get those 6 months worth of figures? Do companies usually prepare half-year results? Sometimes, but for exam purposes, the standard technique you're expected to use is time apportionment. You usually assume that the subsidiary's revenues and expenses accrue evenly throughout the year. So you take the subsidiary's full-year revenue figure, multiply by 612, take its full-year cost of sales, multiply by 612, and so on down the income statement.
Exactly. You prorate each line item based on the number of months the subsidiary was part of the group during the year. Only the post-acquisition portion gets added into the consolidated columns.
What happens to the profit S made in the pre-acquisition period, the first 6 months in our example?
That pre-acquisition profit is essentially capitalized. It forms part of the net assets at acquisition in W-2 and is eliminated against the cost of investment when calculating goodwill. It does not form part of the current year's consolidated profit.
Okay, time apportionment is key for mid-year acquisitions. Now, how do the adjustments we discussed for the CSFP, like PUP, fair value depreciation, flow through into the CSPL?
They have a direct impact on the profit calculation, ensuring that consolidated profit is accurate from a group perspective. Let's take them one by one.
Okay, first, unrealized profit, PUP, on inventory sold intragroup.
If there's PUP in closing inventory at year-end, we reduced inventory on the CSFP. For the CSPL, that PUP needs to reduce the reported profit. It does this by increasing the cost of sales.
Increasing cost of sales, how?
You add the PUP amount to the cost of sales figure in the consolidation schedule, specifically in the column of the company that made the sale.
Ah, the seller distinction again. So if S sold to P, the PUP increases S's post-acquisition cost of sales.
Correct. And if P sold to S, the PUP increases P's cost of sales in the P column. This ensures the consolidated gross profit only reflects profit made on sales outside the group.
Okay, PUP hits cost of sales in the seller's column. What about the fair value adjustments from acquisition, specifically the extra depreciation?
Right. If we had an upward fair value adjustment on, say, a machine at acquisition, we establish it leads to extra depreciation each year.
The $50 K example earlier.
That extra $50 depreciation charge must be reflected in the CSPL. It's an expense of the subsidiary arising because of the consolidation process. So you add that extra depreciation amount, usually to the cost of sales line or maybe operating expenses, in the subsidiary's column for the post-acquisition period.
So it reduces the subsidiary's contribution to group profit.
Yes, ensuring the profit reflects the usage of assets valued at their fair value at acquisition. And remember the flip side, the unwinding of the DTL we discussed.
The $10 K release.
Yes. That $10 K DTL release would reduce the income tax expense in the subsidiary's column, slightly offsetting the depreciation impact.
Complex interaction there. Okay, what about goodwill impairment?
If goodwill has been impaired during the year, that impairment loss is recognized as an expense in the CSPL. It's typically shown within operating expenses.
And how is it allocated in the consolidation schedule? Does it go in the parents column or the subs column?
This comes back to the NCI measurement method. If you use the proportionate share, partial goodwill method, the entire impairment loss goes into the parents column, affecting W5.
Only P's share.
Yes, but if you use the fair value, full goodwill method, the impairment loss needs to be split pro rata between the parents column and the subsidiaries column, representing the NCI share.
So 75% to P's operating expenses, 25% to S's operating expenses in our running example.
Exactly. You need to show that split clearly in your workings if the FV method was used.
Okay, so we've added P and S line by line, prorated for mid-year, eliminated intergroup sales, adjusted for PUP, added extra FV depreciation, charged goodwill impairment. We finally arrive at the total group profit for the year. What's the last step?
The final crucial step is profit allocation. You must show at the bottom of the CSPL how that total consolidated profit is split between the owners of the parent and the non-controlling interest.
So 2 lines, profit attributable to equity holders of the parent and profit attributable to NCI.
Precisely. You have to calculate the NCI share of the profit first.
How is the NCI's share calculated for the CSPL?
It's the NCI percentage, pre-G 25%, multiplied by the subsidiary's individual profit after tax for the post-acquisition period, after making all the relevant adjustments to the subs figures.
Adjustments like
Their share of the PUP adjustment, if S was the seller, the impact of the extra fair value depreciation, the unwinding DTL adjustment, and their share of any goodwill impairment, if the FV method was used. You calculate the subs adjusted post-acquisition profit that take the NCI's percentage of that.
Okay, so NCI percent times S's adjusted post-acquisition profit gives profit attributable to NCI.
Correct. And the balancing figure, the rest of the total consolidated profit, must be the profit attributable to the equity holders of the parent. That's the amount that flows into group retained earnings, W5.
Examiners must look closely at that profit allocation at the bottom.
Absolutely. It demonstrates you understand who ultimately shares in the group's performance.
Before we leave the CSPL, briefly, what about disposals if P sells S during the year?
Disposals. They bring everything together. If you fully dispose of a subsidiary, lose control, you need to calculate the profit or loss on disposal at the group level.
Not just P's profit on selling the share.
No, the group calculation is different. It's typically proceeds from the sale, what P received, PLS, the carrying amount of the NCI at the date of disposal, from W4, because you're effectively disposing of their share too.
No.
L as they net assets of the subsidiary at the date of disposal, from W2, updated to disposal date. L is the carrying amount of goodwill relating to that subsidiary at the date of disposal, from W3 after any impairment.
Wow, that's a consolidated calculation. And where does that profit or loss figure go?
It appears as a separate line item in the consolidated statement of profit or loss for the year of disposal.
And you'd only consolidate S's revenue and expenses up to the date of disposal in that year's CSPL.
Exactly. Similar to a mid-year acquisition, but in reverse. You prorate S's results only for the part of the year it was part of the group.
Okay, we've spent a lot of time on subsidiaries, where the key is control leading to 100% consolidation. But what about situations where you don't have control, but you still have, well, quite a bit of say? Influence.
That's where associates come in, governed by IAS 28. An associate is an entity over which the investor has significant influence.
Significant influence. What does that mean in practice? Is it just about ownership percentage again?
Ownership percentage is a guide, but not definitive. IAS 28 presumes significant influence exists if the investor holds between 20% and 50% of the voting power.
Presumes. So 20-50% usually means it's an associate.
Usually, yes.
Right.
But you can rebut that presumption. You might own 30% but have no influence, perhaps due to a dominant majority shareholder. Conversely, you might own less than 20%.
Like 19%.
Like 19%, but still demonstrate significant influence through other means.
What other means? What's the evidence the examiner would look for if the percentage isn't between 20% and 50%?
The standard gives examples. Things like having representation of the associate's board of directors, participating in their policy-making processes, like decisions about dividends, having material transactions between the investor and the associate, interchanging managerial personnel, providing essential technical information.
So if Haycock owns 19% of Glarimara but appoints, say, 3 out of 7 directors,
that strongly indicates significant influence, overriding the sub-20% ownership. Haycock would likely have to account for Glarimara as an associate. It's about the ability to participate in decisions, not control them.
Okay, so we've identified an associate. We have significant influence, but not control. Crucially, this means we do not consolidate line by line, right?
Correct. No adding 100% of assets and liabilities. Instead, we use the equity method of accounting.
The equity method. What does that look like on the financial statements?
The associate is shown as a single line item in both the consolidated statement of financial position and the consolidated statement of profit or loss.
One line. That sounds much simpler than full consolidation.
It is, in terms of presentation. But the calculation behind that single line needs care.
Let's take the CSFP first. What is that single line called, and how do we calculate its value?
The line item is usually called investment in associate. Its carrying amount changes over time, reflecting the investor's share of the associate's results and distributions. The calculation typically follows these steps.
Right.
1. Start with the initial cost of the investment, what the parent paid for the associate stake.
Okay, cost.
2. ADD the parent's percentage share, say 30% of the associate's post-acquisition profits and other comprehensive income. So if the associate makes a profit after we invest, our share increases the investment value.
Add share of post-acquisition profit. Makes sense.
3. LAS any impairment losses recognized on the investment. We don't calculate goodwill separately for associates. It's considered part of the cost, but we still need to test the whole investment for impairment.
Less impairment, okay.
4. LAS the parent's share of any dividends paid by the associate.
Hang on. Why do dividends reduce the investment in associate carrying amount? When we talked about subsidiaries, intra-group dividends were just eliminated because they were internal transfers within the group. Why is it different here?
That's a really sharp observation, and it highlights the conceptual difference. An associate is outside the consolidation boundary. It's not part of the single economic entity in the same way a subsidiary is.
Okay.
So when we add our share of the associate's profit to the investment, step 2, we're increasing the investment value based on profits earned but not yet distributed. When the associate then pays a dividend, it's distributing some of those profits.
Ah, so receiving the dividend is like getting back a piece of the profit we've already recognized in the investment carrying amount.
Exactly. It's a return of the investment, not a return on investment in the same way an external dividend would be. Receiving the cash dividend reduces the net assets of the associate, so our claim on those net assets, the investment carrying amount, must also decrease. It prevents double counting the benefit.
That's a subtle but crucial difference from subsidiary accounting. Dividends from an associate reduce the investment asset.
Got it. What about the CSPL presentation, the single line there?
Yes, in the consolidated statement of profit or loss, the investor recognizes its share of the associate's profit or loss for the year as a single line item.
What's it usually called and where does it sit?
Often called share of profit of associate, or similar. It's usually presented somewhere below gross profit, often just before profit before tax.
And the calculation is simply?
The parent's ownership percentage, for example, 30%, multiplied by the associate's profit after tax for the year, making sure to only include the post-acquisition period if acquired mid-year, less any impairment loss recognized against the associate investment during the year.
Straightforward enough. Parent percent times associate's profit less impairment. Now, what about intragroup trading? If P sells goods to its associate A, is there a P adjustment?
Yes, there is still a PUK adjustment, but it works slightly differently than with subsidiaries.
Because the associate is outside the group, we only need to eliminate the unrealized profit relating to the group's share of the transaction. We don't eliminate 100% of the PUP.
Only the group's share. So if P owns 30% of A and P sells goods to A with the $10,000 unrealized profit still held by A at year end, we only eliminate 30% of that $10,000. So $3,000.
Exactly. You only eliminate the investor's share of the PUP.
And how is that elimination done? What's the journal? It depends on the direction again, right? Downstream versus upstream.
Yes. If the parent sells to the associate, downstream, the profit is in the parent's books. You need to reduce the parent's profit and also the carrying amount of the investment in associate because the associate's inventory assets are overstated from the group's perspective, reducing the value of the group's investment. So the adjustment is debit group retained earnings cost of sales for the $3,000 and credit investment in associate for the $3,000.
Credit the investment. Okay, that's different.
Yeah. If the associate sells to the parent, upstream, the profit is in the associate's books. You need to reduce the group's share of that profit and reduce the group's inventory value. So the adjustment is debit share of profit of associate in the CSPL, reducing the income recognized from the associate by $3,000, and credit group inventory on the CSFP by $3,000.
So downstream hits parent's RE and the investment asset, upstream hits the share of profit line in CSPL and group inventory, and crucially, it's only the group share of the PUP being adjusted.
That's the key takeaway. Only the investor's percentage of the PUP.
Final check on associates. What about outstanding balances if P owes the associate money or vice versa?
Yeah.
Are those eliminated like with subsidiaries?
No,
Or
absolutely not. This is another common mistake.
why not?
Because the associate is not part of the consolidated group, it's treated as an external party for this purpose. So any receivables or payables between the parent, or a subsidiary, and the associate remain on the consolidated statement of financial position. They are not eliminated.
Okay, so PUP is adjusted, partially, but balances are not eliminated for associates. Big difference from subsidiary accounting.
A very important distinction to remember for the exam. So wrapping up, group accounts can seem daunting, but honestly, it's not about magic. It's about applying principles consistently and crucially maintaining that structure in your workings. Discipline is key.
Absolutely. If you approach it methodically, step by step, using those standard workings, W1 to W5 as your guide, you really can master it. Let's quickly recap the sort of 4 big strategic areas we covered today that need laser focus for exam success.
Okay, first, control is everything. Always start by determining if control exists. Look beyond the percentage, look for power to govern. If control exists, it's 100% line-by-line consolidation. Substance over form.
Right. Control dictates the method. Second.
Second, CSFT workings are critical, especially W2 net assets, W3 goodwill, W4 NCI, and W5 group RE. Be meticulous. Remember the impact of the NCI measurement choice proportionate share versus fair value on goodwill and impairment allocation.
And don't forget those fair value adjustments at acquisition.
And the resulting deferred tax liability and the ongoing impact of extra depreciation and the DTL unwinding. Those are higher level marks waiting to be claimed.
Okay. Third key area.
Third, CSPL requires elimination and prorating. Get the 100% eliminations of intragroup sales and balances right. Be sharp on time apportionment for mid-year acquisitions. Only include the post-acquisition period. And ensure PUP adjustments hit the seller's cost of sales.
Seller, seller, seller for PUP. Got it. And fourth.
Fourth, associates use the equity method. Significant influence, 20–50% usually, but check other factors, means a single line investment in the CSFP and a single line share of profit in the CSPL. Remember, dividends received reduce the investment carrying amount, and PUP adjustments are only for the group share, and no elimination of balances.
Perfect summary. And maybe final word on just exam technique, presentation.
Clarity, structure. Make it easy for the examiner to follow your thought process. Label your workings clearly, W1, W2, W3, W4, W5. Show the inputs to your calculations. If they can see how you got to a number, even if the final number is wrong due to an earlier slip, they can award partial credit. Messy, illogical workings get very few marks.
Avoid those common traps too, right? Like forgetting the unwinding discount on deferred consideration, mixing up the PUP seller, ignoring FV adjustments or DTL.
Exactly. Think like the examiner. What are the classic pitfalls? Be aware of them. Practice helps you spot them instinctively. It's manageable if you break it down. Master those 5 core workings, understand the principles, and you'll be in a very strong position.
Excellent. Well, this deep dive into group accounts is, of course, part of the SmartPass series. We're aiming to give you high-impact support, that expert voice to guide your revision.
And we'll be tackling more IFRS topics, doing more consolidation walkthroughs, and sharing specific exam strategies in future sessions.
So do check the description below this recording for links to SmartPass study resources. And definitely subscribe to the SmartPass YouTube channel so you don't miss out on more expert guidance.
Keep practicing those workings. Understand the why behind each adjustment. Don't just memorize journals. Understand the concept.
That's the best advice. Okay, that's all for this deep dive. Go out there and conquer those group accounts. We'll see you next time.